The most effective investors don't follow trends. They interpret capital flows early and align accordingly. As we enter July 2025, institutional capital in the UK is moving with purpose toward assets backed by fiscal policy, regulatory momentum, and structural demand. Quiet moves with long-term implications. I'm a chartered accountant specializing in tax strategy and global investing, helping professionals and entrepreneurs build efficient, long-term wealth. In this channel, I share actionable insights, not theory, for professionals and high earners navigating real-world markets. Here's where the smart capital is positioning this month, and how to structure your exposure for maximum long-term efficiency. Let's begin with AI, not the media narrative but enterprise infrastructure. In the UK, the serious capital is bypassing consumer-facing platforms and focusing on back-end systems, inference accelerators, regulatory compliant AI platforms, and secure compute infrastructure. We're seeing increased investment in firms aligned with NHS digital transformation, FCA compliant AI audit tools, and sovereign defense technologies. These aren't headline stocks, but they're critical to the UK's AI backbone. Strategically, consider targeted UK-based AI funds or specialized AEM-listed equities serving the B2B sector. Investors should also monitor FCA sandbox pilots. Several fintechs are preparing compliant AI risk frameworks for financial institutions. Next, energy transition, where government policy, security risk, and investor returns are now tightly linked. The UK's energy strategy is undergoing a quiet shift. Yes, renewables remain important, but the emerging opportunity lies in energy grid digitization, modular nuclear, and green hydrogen. What's critical to understand here is that we're no longer just talking about decarbonization, we're talking about energy sovereignty. The UK's reliance on imported gas has proven geopolitically fragile. That's why the government is backing solutions like distributed storage and advanced metering, not just for climate goals, but to secure long-term pricing stability. Private equity is moving in quietly, acquiring firms that enable demand response, battery aggregation, and grid data optimization. And for investors, these aren't speculative moonshots. They're real assets with utility contracts, RPI-linked returns, and rising strategic value. And Ofgem's revised incentives now support infrastructure upgrades and grid resilience initiatives. That's where institutional capital is flowing. We're seeing increased positions in investment trusts focused on energy infrastructure, especially those with diversified exposure to clean storage, microgrids, and low-carbon transition assets. These vehicles often benefit from guaranteed purchase agreements and inflation-linked revenues. Now let's address a structural change in the UK economy: the rise of smart manufacturing. Driven by post-Brexit supply chain resilience and reshoring incentives, the UK is reindustrializing, not with factories of the past, but with precision robotics, AI-led quality control, and real-time production analytics. This is a macro-supported opportunity. Government-backed schemes such as Made Smarter and full capital expensing under the new fiscal framework offer real tailwinds. Public equities benefiting from this trend include automation component suppliers, advanced manufacturing software platforms, and UFTSE Industrials with AI integration. Watch for funds tracking UK industrial innovation. Many are quietly outperforming broader indices. Now let's shift to alternative yield. Inflation remains sticky and base rates have likely peaked. Institutional investors are reallocating toward high-yield, secured instruments outside traditional bonds. In the UK, we're seeing growing allocations into asset-backed lending platforms, royalty-based income trusts, litigation finance vehicles listed on the LSE. These often yield 7–10%, and many are eligible for tax-advantaged wrappers. The strategic move here is structure. holding select private credit assets via a SIPP, SSAS or IFISA offers legitimate tax sheltering while maintaining liquidity. Due diligence is critical. Prioritize platforms with audited track records, regulatory oversight, and skin-in-the-game underwriting. Let's address digital assets, but filter out the noise. The real opportunity isn't in speculative tokens, it's in the tokenization of regulated assets. FCA-regulated pilots are now live, testing tokenized gilts, carbon credits, and real estate titles. The value isn't volatility, it's instant settlement, fractional ownership, and programmable compliance. For strategic exposure, consider indirect investment via UK fintechs, building compliant blockchain infrastructure, or digital asset ETFs authorized under UK frameworks. And always consider the tax perimeter. Crypto held within a UK limited company or pension wrapper is subject to entirely different outcomes than personally held assets. Structure accordingly. Finally, international property, not for lifestyle, but for jurisdictional diversification. Wealthy UK investors are acquiring strategic assets in Portugal, Malta, and Greece, not just for yield, but for access, residency, and succession flexibility. In a tightening HMRC environment, these moves offer dual benefit: property-backed cash flow and global mobility or citizenship options under EU investment migration programs. These acquisitions also serve as currency hedges, estate planning tools, and potential bases for non-dom tax status, where appropriate and compliant. Before we wrap up, a word on risk-adjusted positioning. What we're seeing in July isn't just sector rotation, it's a strategic recalibration toward resilience. In a high-tax, high-regulation environment like the UK, the edge no longer comes from chasing alpha, it comes from reducing friction. That means choosing asset classes that provide yield with optionality, geographic diversification, or structural tax sheltering. For high earners and entrepreneurs, the real advantage lies in alignment. Investments that fit your business, your jurisdiction, and your future liquidity plan. Don't follow headlines, follow the incentives. That's how smart capital stays ahead of both markets and policy. Let's bring it together. The sophisticated capital in July 2025 is repositioning, not chasing markets, but engineering exposure through enterprise-grade AI infrastructure, grid-focused clean energy backed by Ofgem reforms, smart manufacturing with tax-advantage capex, alternative yield through legally protected income streams, tokenized real-world assets under regulatory pilots, and property plays that hedge both tax and sovereignty risk. The differentiator isn't just what you invest in, it's how you structure it, with the right wrapper, jurisdiction, and timing. UK high earners face some of the most complex and aggressive tax landscapes globally. That's why smart investing is never just market-focused, it's always tax-aware. If you found this briefing valuable, subscribe. This channel delivers the same level of strategy you'd expect from a private client desk, designed for entrepreneurs, senior professionals, and globally mobile investors. Thanks for watching. I'll see you in the next one.